Good morning, everyone. My name is Josh Davis, and I serve in the role of Vice President, Food and Agribusiness, specializing in beef cattle lending for Farm Credit Mid-America. We are a financial services cooperative serving 80,000 customers across Indiana, Ohio, Kentucky, and Tennessee. While the world around us has changed, we remain focused on securing the future of rural communities and agriculture, one home, one farm, and one business at a time. Thank you for being here today. Because we work closely with beef producers across our 4 states, we know many of the challenges and opportunities you are experiencing today. In addition to having the financial strength to work alongside our customers, we also have access to leaders in the beef industry like the one that you'll hear from today. We hope today's webinar provides useful information about what's happening in the marketplace and that you'll leave with information that aids in the business decisions you are making. Today, we bring you an expert to speak on current beef market conditions and associated opportunities. Before I transition over to our speaker, I want to reiterate that this webinar is intended for the audience on today's call for informational purposes only and is not for public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. Let's get started. I'd like to introduce you to Lance Zimmerman. Lance was raised on a diversified crop and commercial cow-calf and backgrounding farm in northwest Kansas. After graduating from Kansas State University with a bachelor's degree in agricultural communications and journalism, Lance worked for 5 years as marketing manager for Certified Angus Beef. He then earned a master's degree in agricultural communication economics from K-State in 2010. In 2011, Lance joined CattleFax as an analyst and is currently a research data and analysis manager. Lance's primary responsibility is managing the CattleFax member database as well as coordinating the organization's fundamental research and analysis for the cattle and competing protein markets. Lance and his wife Andrea live in St. George, Kansas with their children Lawson and Macy. He enjoys helping on the family farming operation, coaching, hunting, and working on vehicles and home improvement projects. Lance, thank you for being with us today.
Thank you, Josh. Appreciate your allowing me to work with your customers. I know that you guys treat anyone that you bring in front of your customer base with an immense amount of scrutiny and respect, and so I appreciate you trusting me to carry a message on to your customers today, especially in light of what we're dealing with right now. I think the title of the presentation, Navigating Challenges in Today's Marketplace, is especially fitting in 2020. Obviously, every year brings its unique challenges, but I think this one is one that will stick out in a lot of our minds for an awful long time as being one that brings an extra set of challenges to the cattle business, whether you're a cow-calf producer, stocker operator, backgrounder, or finished feed yard. And so we often talk about 2013, the BSE year. We often talk about the 14-15 highs. And I think that COVID-19 will have its special place in all of our minds and hearts for a variety of different reasons this year. And so I hope that I can outline for you all a discussion today that offers all of you a perspective of kind of what we've seen in the marketplace develop throughout the course of this calendar year, but also give everyone an opportunity to understand in detail where we think that this year is going and where we think it's going into 2021. A big part of what COVID-19 adjusted for us was the fundamental view of this marketplace. It's changed our expectations for supply and demand. And usually, if we're dealing with a normal, quote-unquote, market year, we expect volatility. We expect uncertainty to exist. But to totally have our feet knocked out from under us is quite rare. As we talked about coming into 2020, one thing that we thought was certain, and we believe still exists today, is the idea that contraction is still a reality in this cattle business. And by contraction, what I mean by that is the cow herd is continually and slowly getting a little bit smaller after we put in the peak 2 years ago. What I hope to do for us is explain where we started with that, what that's meant from a supply setup as we came into 2020, and now thanks to coronavirus, where we think we're going as we go into 2021. Things have certainly changed a little bit as we went through this spring, and I think understanding what the baseline assumptions were and then how the deck got reshuffled is going to be important for us. In light of that, I want to give you an update on what we see are some of the market conditions that we need to be in mind of as cattle producers as we navigate the second half of this year and look ahead to next year. There's certainly a high degree of uncertainty that still remains, but there's also a high degree of things we can check off the list that now we can gain some comfort with as we look at this marketplace and talk about what it looks like post-COVID-19 and this new reality we live in. And so I hope to discuss some of those things with you all this morning, give you some of that comfort level that we see as well as we step back and look at this marketplace. And then lastly, I hope that I can bring it all together for you all. Paint you a very good market outlook, at least give you some trends on directionality as we look at the various calf, feeder cattle, fed cattle, and for some of you, even the Holstein calf market, as you look at that as a revenue stream for your operations, and paint a picture not just for the short term, but as we look into next year as well. So let's roll up our sleeves a little bit. As we talk about the marketplace, I think the one thing that shaped all of our expectations and continues to shape our expectations going forward is we've built a good supply of cattle around us as an industry today. We thought there was an off chance that we would actually rebuild the cow herd back to where we were in the previous cycle highs around 2016. We fell just a little bit short of that. And I think the reason for that is partially due to reaching capacity. I think another part of it is we've taken some ground out of crop production or out of pasture production and into crop production. I think another part of why we fell short is a little bit the age of the cattle producer. As we get older as a cattle producing segment, inherently we become a little less likely to take on additional risk. Another reason for falling just short of that target is probably the volatility we went through as we had peak protein supplies across beef, pork, and poultry in 2016. And we really hadn't built up the export markets to absorb that production yet. And it meant that as we went through the second half of 2016, we already set a lot of price targets from the low end of the range. And those price lows that we put in at that time have continued to hold even as we worked through COVID-19. And so as we look at this peak, it's important to examine what we did as we built this inventory from the lows back here in 2014 and 15 to the highs that we're realizing today. We have 3 million more mama cows on U.S. cow-calf operations. To date, we've produced 2 million additional feeder cattle and calves, and that number is likely still on the increase. And we've added about 1.5 million cattle in feed yards. And again, that number probably has room to continue to increase. And so we have a lot of cattle around us. And so when we talk about an event that really knocks the demand down a notch, 2 or maybe 10, depending on how you look at it with COVID-19, we were certainly in a susceptible place because we had a lot of inventory ramped up. And not just us, but again, our neighbors in the pork and broiler industries as well. We had a lot of pork and chicken available in the marketplace, and it needs to find homes, not just here in the U.S., but even globally. And so as we look at this, I think this is important to just remember where we've been, where we've gone to now. And the idea is as we go through these typical cattle cycles, it generally takes 10 years between peaks. And so you can basically understand that our supply is going to be either in a peak or a valley roughly every 5 years. And so we're going through the peak now. The idea is as we work through these next 5 years, we're going to gradually drain on these supplies, rebuild the prices in the industry, rebuild the margin, and ramp back up for the next expansion. So the cow herds peaked and COVID hit. Now what do? Well, obviously, the cow herd's in decline, and we got confirmation of that as we got the July 1 cattle inventory report from the USDA last week. But you can see that basically we took 400,000 head of cattle out of the cow herd as we got to January 1 of this year. Our expectation is, based on what we're seeing from a culling rate perspective and heifer retention perspective, that we'll take another 300,000 head out of the cow herd again here in 2021. We'll continue to probably see steady to smaller cow herds as we work through the next 5 years, with the idea being as we get out to 2024, 2025, we'll start to stable out the cow herd. The expectation is probably somewhere right around 30 million head, and we'll rebuild the cow herd again. And so as we work through that, that's our expectation. And I think one of the things that naturally becomes a question as we present this type of data to folks in the countryside is, well, why can't we build this herd bigger with each successive cycle? We certainly did that all the way through the 70s as you look at what beef cow inventories did at their peak. But every year since, we've seen these two trends diverge, right? The single biggest reason why is we've gained productivity as an industry. Many of you know we started adding in the muscle and high-yielding breeds into the industry through this period in the 70s and 80s. High muscle, high growth. We also introduced a lot of reproductive technology into the herd throughout that time. Better conception rates, better feeding technologies, better health. As we work through this, we've allowed ourselves to see better beef production in light of what we have from a cow inventory perspective. Even though our cow herd is no bigger than it was back here in the early 60s, beef production's at a record high. And so as we look at this going forward, that's part of the reason we see some of this decline. But we believe that a lot of the trends that led to the initial aggressive downward pressure are going to be flatter now as we go forward. And we think that we can operate in an area, if we continue to build demand domestically and globally, where we can keep that cow herd very steady between kind of 30 million at a low and roughly 32 million or so at a high. A lot of it's going to depend on how volatility treats us, how we continue to transition these operations from one generation to the next. But trying to work with you all to preserve your economic viability is paramount for CattleFax and what we try to do from an industry standpoint. As we talk about the setup we had this year, we knew going into 2020 we were going to have a lot of cattle on feed. And even with sharp reductions year over year in placements on feed yards through this spring, we still have a very ample supply of cattle on feed on July 1. The challenge is, as we look at this supply, well, it's basically the second largest in history. It's very much front-end weighted. What I mean by front-end weighted is there's a much higher percentage of cattle ready to hit processing plants today than there was a year ago at this time. The single biggest reason why is because COVID-19 slowed down slaughter. I have three graphs for you here. In the upper left, you're going to see fed cattle slaughter, steer and heifer slaughter, cattle coming out of feed yards. You're going to see non-fed cattle slaughter, basically those mature cow and bulls, and then hog slaughter. Doesn't matter which one we look at, each one of them was affected drastically by COVID-19 slowdowns. Plants couldn't get the labor to process the cattle and the hogs necessary to create the product for consumers. You all probably recognize it as you went to grocery stores and you saw the news, meat cases were cleaned out, shelves were stripped clean. This is why. The challenge is now as we go into this, what we call the new normal. None of these industries are back to 100% of where they were pre-COVID. Specifically when we talk non-fed slaughter and hog slaughter, seasonally, those two production levels tend to decline as we work into the summer months. So that may not be a fair observation as we look at those two. But we certainly can say it as we look to fed slaughter. Because seasonally, our largest months for fed cattle slaughter each and every calendar year come in June, July, and August. And so as we look at it, we're basically operating about 5 to 10% of pre-COVID levels. And the other industries are very similar as we look through them. Now, there's two things we can glean from this. One is restrictions on spacing, throughput, and otherwise are going to keep these industries from ever regaining the capacity they had pre-COVID. That's certainly a possibility. It may take us another 6 months to a year to regain some of the lost capacity and get back to whole again. The other side of the equation could simply be that demand is not quite what it was pre-COVID. And packing plants are adjusting their slaughter expectations and trying their best to allow supply to equal demand going forward. And we think that equally could be plausible here as we look at what's going on today. Regardless of what it is, this is the trend that's going to likely continue as we work through at least the next 6 months, and then we'll see what 2021 brings. But we probably are a little more limited on our topside capacity from a processing standpoint as an industry today. Where that matters is we're still paying for those initial slowdowns. At its worst, fed cattle slaughter was down about 35% relative to a year ago. And as we did that, and we built shortfalls basically in April and May, and tried to recover in June, we built a front-end supply. For the uninitiated on the call, typically about 150 to 200 days on feed is what it takes to finish an animal in a feed yard and send it onto a packing plant. And so this is the cattle on feed in U.S. feed yards over 150 days. This is essentially our front-end market-ready supply. We built this supply basically into a million head surplus relative to a year ago by the time we hit June 1. We reduced that gap just ever so slightly to 960,000 head higher than a year ago on July 1. If we continue to hit CattleFax's forecast for fed cattle slaughter, it'll still take us all the way through the summer and into the early part of fall to get that market-ready supply of cattle back to year-ago levels. It's not going to be due to an aggressive increase in slaughter that we get there. It's going to be due to the fact that as feed yards were experiencing things in March, April, May, and June, that we also sat back and placed fewer cattle in feed yards. So essentially, there's a hole in available marketings that exists as we work through July and enter into August, September, and October that's going to allow us to take this surplus and basically push it right into a hole that exists in our fed cattle supplies. And so that's the challenge that we're working through. We not only have a slug of cattle in feed yards on the front end that we have to work through, but we also have an increase in cattle sitting outside of feed yards waiting to get in. The July 1 supply of cattle outside of feed yards is up 300,000 head compared to a year ago. And there's reason to believe that it could maybe even be just a little bit bigger than that as we look at what that supply is of available cattle for feed yards right now. And so we got some cattle outside of feed yards, we got cattle inside of feed yards piled up. And what it means is as we continue to work through 2020 and we look ahead towards 2021, we're going to have a very ample supply of cattle available for slaughter. We'll likely surpass the slaughter levels we put in 2019 in 2021. And the production of those cattle will be higher as well, the resulting beef production from those cattle, because the carcass weights will be bigger. These cattle continued to grow as they were waiting to work their way through the system. And so that's the setup from a supply perspective as we look at this marketplace. More cattle on feed, steady cattle on feed, but more on the front end. More cattle waiting outside of feed yards. As we transition to 2021, the calf crop declines that are resulting from that smaller cow herd will start to be realized. And our expectation is as we work through the second half of 2021, we'll start to realize year-over-year declines in fed cattle slaughter and start to see a more supportive cattle complex as we get into the second half of next year. So now, let's talk about some of the things that we've learned as we've worked through COVID-19. And I kind of frame these up right now as the knowns and the unknowns. And I think every year as we navigate the market, there's certain things we know and there's certain things we don't. We got to just watch them play out. This year, the list of knowns started out a lot stronger and dwindled down to only a few things as we work through the spring. We're starting to stack back in a pile of factors that we know, and we're starting to whittle away at the number of factors that are still uncertain to us. And so as we look at this year, one of the things that we see is as we drained those meat cases, as we saw that cattle slaughter fall 35% below a year ago, we slingshotted the wholesale cutout value. In other words, the value that retailers and restaurants paid for beef. And what we did was we took this cutout to never seen before highs. Just to put that into perspective, the previous high was back here in July of 14 at basically $2.64 a pound. We crushed the record as retailers scrambled to refill meat cases and turned a blind eye to what the price was. And it only took 6 weeks to take it from record, never seen before highs to basically testing the bottom end of the recent price trend, taking cutout values below $2 a pound. The risk is, can we hold that support level? And what we know is, even if I just draw this next line down here, that represents a $1.90 cutout value. Since even 2014, the start of this graph, we've only spent 5% of our time below 190. So holding this $1.99, $2 area that we're at today is critical. As we look at it, we believe we will hold that level going forward. We're slowly making some gains. Customer traffic at restaurants continues to make small incremental progress, and restaurants continue to do a great job of filling the consumer's needs. If we're going to have risk below that price point, below this $1.99 to $2 that we're trading at today, it's going to be because we stubbed our toe from a demand perspective at some point in time. And we'll talk about that in a little bit. Retail, they were getting choked out by wholesale prices approaching nearly $5. As those wholesale costs went up, so did the price they had to pass on to consumers at the meat case. Our prior all-time high for retail prices was back here at about $6.15 a pound. Similar to the wholesale market, the new highs have crushed it. But for perspective, April, May, keep grabbing that line, May and June retail prices averaged basically up about 15% relative to prior year values. The cutout cost passed on to them through that same 3-month time was up 22%. The retailer, even with these 3 months of aggressive price increases that they passed on to consumers, still is at a loss. And we believe they'll start slowly correcting these prices through the summer. Our forecast is the dashed line. We think eventually we'll get back to a price point where prices will be around $6 as we get to the end of this year. Our annual average forecast for next year is a $6 average. But they have the advantage of taking some slow adjustments going forward because nobody's forcing their hand. One, they're not struggling for customers coming in the door. Two, there's no market share battle among retailers to try and take those customers away from other grocery stores. Three, food service isn't a viable competitor today with retail. They're a shell of themselves because of all the things that happen with COVID-19 and social distancing and just general uneasiness that exist among the U.S. consumer and being out in the public and crowded spaces today. And three, while exports are while exports are exceptional, we're in a situation where retail still is in the driver's seat. And so as we look at this, we do believe they're going to correct lower. We do believe the initial breaks will be more significant than the later breaks, but retail has every reason in the world that they can slow play this and try to recapture some of that margin. And I believe that once they get made whole again, we'll see these prices normalize and we'll have a normal seasonal in retail price trends. To that point of being made whole again, when we were in the pre-COVID environment, we lived in an environment where 60% of our beef sales came at food service. 40% of beef sales came at retail on a volume basis. After COVID hit, huge reductions in food service volume, massive increases at retail. But as price points increased at retail, the beef volume slowed. And then eventually we hit a point of bottoming about mid-May, where food service started making slow but gradual improvements. As retail started adjusting prices and putting back product on ad and refilling meat cases, we even started to see a small but gradual improvement at retail as well. But the challenge is, as we look at it and look at the map on a week-to-week basis since the start of COVID, we're still operating in a scenario where basically over the last 4 weeks, beef sales volumes are still down about 14%. If we want made whole again, the easiest way we can do it is get the food service volume to recover. And that's going to be a challenge because a lot of distancing orders still exist in areas. It feels odd for consumers to be wearing a mask while they're trying to eat food and have conversation. And even though carryout has increased, even from casual dining chains, the reality is the white tablecloth restaurant business has been decimated. Typically, when you eat at a white tablecloth establishment, yes, you're going for a great meal, but you're going for the experience. And quite frankly, the experience is just not the same today. And so that remains a known that we have to navigate through going forward. How do we rebuild food service? How do we get confidence back into the U.S. consumer to participate in those trends? And how do we benefit then from that by being made whole again from a demand segment standpoint? And we're not quite there yet today. And so a little bit closer to the ranch, there's 3 rules that we kind of have for the cow, calf, and stocker segment. And depending on the answer to these 3 questions will dictate what the general outlook is for those segments, both immediately in the short term and longer term. And the first question we ask ourselves is downstream segments. In other words, stocker, backgrounder, feed yard, packer, retailer, are they profitable today? If the answer is yes, that's good news for cow-calf producers because it means demand is robust and interest in calves is strong. Well, unfortunately, things are a little tough right now. Obviously, our friends in the stocker business and feed yard business have taken on massive losses. The packing industry is doing incredibly well right now. And the retailer, while they took it on the chin through the spring and early summer, is likely to see some recovery going forward. And we just talked about the challenges of food service. So this is a very mixed to negative outlook short term, but we do see some opportunities for stockers and feed yards as we look to 2021. They've been buying much more competitive break-evens coming out of COVID-19, not necessarily hedgeable profits on the purchases they're making, but there's at least the prospect of making some money on cattle they brought in over the last 3 months and probably look to sell as we work through the end of this year and early 2021. Next, are the industries in the protein segment expanding? Cattle, hogs, and broilers. Or are they contracting? Today, I would tell you, major contraction on the hog side, short-term contraction on broilers, continued expansion of total cattle supplies, but the cow herd is shrinking. And so as we look at this, again, kind of a mixed outlook that we'll talk about. And then lastly, are the outfront markets at a premium or discount? In other words, are they higher or lower than the market we're looking at today? We're building back in a premium into this marketplace as we look out towards the winter months. Generally speaking, premiums in the out front funnel back to optimism on selling calves and feeder cattle. And so that's our expectation as we look at it today, that this one is much more positive as we cross it off the list. And let's talk about this all in a little more detail so we can arm you with some tools in your toolbox. One of the things that we know is that when cattle feeders start taking on a loss position, and that's highlighted by these blue lines below par, it tends to weigh on the feeder cattle market. This is just simply a year-over-year change in feeder cattle prices. We've spent a lot of time since 2018 with the cattle feeding segment taking on massive losses. It's no shock that the feeder cattle market can hardly find higher year-over-year bids in that environment. We just went through, again, a period of dramatic short-term losses. The deepest losses through the first 7 months of this calendar year since 2013. As we continue to work through this going forward, that's going to keep buyers cautious. And the same is true for feeder cattle sellers. They went through massive losses through the first 6 or 7 months of this year. They're going to be more cautious as they look to buying calves here going forward. The good news is there's a glimmer of hope. And what we have here is basically the price of current fed cattle with the purple line against the break-even price for those cattle. Massive losses during the packing plant fire, massive losses again due to COVID. But the futures market is projecting fall and winter profitability. As we look at this going forward, the cattle feeder finally sees a glimmer of hope. And that glimmer of hope has been bid into a higher fed feeder cattle market so far this summer. We've also seen very strong prices for calves on the summer video auction market. And we'll talk a little bit more about how we believe that'll shape our price outlook as we work through the rest of the year. I mentioned contraction in the competing protein industries. And I know this chart's a little bit busy, but I want you to bear with me. What we have here is breeding hog slaughter. So basically, how many sows and boars are heading to processing plants? On the flip side, we have broiler eggs set. In other words, how many broiler eggs are going to hatcheries to essentially turn into broilers later on down the road? Then on the left, I have just the percent year-over-year change. We've seen a massive increase in the number of sows and boars going to slaughter. At its peak back here in early May, it was a 15% increase relative to a year ago. More lately, it's been about a 10% increase. But a huge, massive uptrend as we look at breeding hog slaughter as we transitioned into 2020. This die was already cast well before COVID, and COVID kicked it into turbocharge mode. As we talk about broiler type eggs set, massive correction lower during the worst of COVID-19. And so what's this mean from a time horizon standpoint? What it means is through the summer months, we're going to see broiler production really lag back below year-ago levels. We're realizing that now. They're starting to get back towards year-ago levels again from an egg set perspective now. What that means is by late summer and fall, we're probably going to see some pressure on us again from a strong broiler production, strong chicken production number. Very short-lived contraction, but enough to give us some breathing room through this summer, early fall period. Breeding hogs, if you remember the hog slaughter graph from earlier, we have plenty of hogs to get us through the end of this calendar year. But the fact that they're reducing the breeding inventory and cutting back farrowings as well means as we get into 2021, we expect to see some significant year-over-year shortfalls in the amount of hogs being slaughtered and pork in the marketplace. So still some short-term pressure from a supply perspective on the hog side, a little bit of a give and take relative to what that looks like between pork versus poultry. And we know we have massive cattle supplies still out there in front of us through the next 6 to 12 months. So what I would tell you is It's a neutral to slightly negative production picture across all the proteins, with probably the biggest burden to be bared out by the cattle producing segment. As we talk about the single biggest way we can alleviate that, it's exports. And that's been the message since basically 2015. As we look at this year, we feel pretty confident that we'll see stronger exports for each of the three main protein groups. I think we have the potential we could crush this 15% increase year over year on pork. Feel pretty good that we'll hit the 8% target on broilers. We may fall just a percentage point or two short of up 5% on beef. But the trends are right. We're making progress as we work through this. The single biggest reason we could see pork go higher is if we keep active in getting exports to China. And that's no small task. They've been a very finicky dance partner for multiple years. But they've been an aggressive buyer of U.S. pork over the last 6 or 7 months. They've also been a very aggressive buyer of broiler meat. African swine fever is still a very challenging thing for China to work through. They still, even with COVID capturing all of our domestic headlines, African swine fever that decimated their hog herd 2 years ago is still a very real reality for everyone living in China today. As a result, the U.S. has been in the driver's seat in trying to get more and more of our protein on their dinner plates. As we talk about expansion, as we talk about strong beef, pork, and broiler numbers, it's going to be easier for us to move the export needle than the U.S. consumption needle. You can see we basically are at between 85 and 90 billion pounds for production going right to our domestic market. As we look at it, though, we continue to make gains on the export front. And that needs to continue to be the case going forward if any of our industries, whether it's us or our competition, hope to continue to expand going forward. And we think the door's open. We think with Australia going through a herd expansion right now, the U.S. is slowly becoming a buyer of choice in the global marketplace specific to beef. As we look at the market, we talk about those outfront contracts. If they're at a premium or a discount, we're at a massive discount due to COVID. Prices trending on a live cattle strip basis, basically the front 6 live cattle contracts, at the lowest level that they had since the start of the decade. As we look at it now going forward, we've made great headways, challenging basically the 110 resistance level right now. As we look at it going forward, we think we can stay and maintain our historical trading range that we've been in basically since the start of 2017. Trade in a range from a futures perspective where the bulk of the time we are spending our trading range in is between 105 and 125. Again, very seasonal that we would challenge those highs as we get towards spring. We would bottom those prices on a futures basis for live cattle as we get into the summer. But we think that as we continue to work through these demand challenges and carryover challenges that exist, we can continue to pump some upside back into this marketplace. That's good news for those folks looking to sell calves and feeder cattle through the second half of this year. So if those are some of the things we know, what are some of the challenges that still exist? What are some things that we're still a little bit uneasy about as we watch the data? And obviously, it's dominated the discussion so far this morning. I'd be remiss if I didn't put some data in front of you regarding coronavirus cases. Obviously, you all hear it in the news. I don't need to belabor the point. We're approaching daily caseloads between 70,000 and 80,000 a day at their peak right now. But as we look at this and we navigate this trend, our death rate is falling. At its worst, it was over 5%. More recently, it's closer to a 3% death rate. I don't want to minimize the virus. If any of us had our way about it, we'd ask this thing to be vanished from our country as soon as possible. But the reality is we're learning more about the virus. We're testing more folks for the virus. We're getting better at treating people for symptoms that come from the virus. As we work forward, I share this with you to say the biggest challenge today, in our opinion, is not the number of cases and not the number of deaths. It's getting the American public to have a certain level of comfort and acceptance with the new reality that is the coronavirus and variants of it are going to continue to be with us throughout the rest of history. It's hard to shake fear. We would have an irrational fear of driving cars if every single day the national media plastered every new car-related death on the news. But yet, we've accepted driving cars have an inherent risk. We wear seatbelts, we put airbags in our car, we take the necessary precautions to minimize those risks, but we can never completely wipe the slate clean. Automobile deaths are still going to happen every day. It's the same but different with the coronavirus. People are going to get it every day. New people are going to get it. The reality is, every one of us on this call will probably get it at some point. But the odds of us dying are exceptionally low. And medical science has come a long way in this short period of time to understand how to treat it. Do we have to understand it? Absolutely. But the reality is we also have to learn and grow as a culture to understand how we move forward and understand that we are going to live with this. And how do we get back to an everyday life? And that's the biggest unknown that still exists, because we're not there as a society yet. Another reality that we still got to sort out is, what does the consumer income situation look like? On a monthly basis, real consumer incomes are basically back at levels that they were in 2015, 16, and 17. We took a huge hit on income. As we look at it, it's still better than where we were at the recession lows, about 20% better. But the challenge is nearly 30% of that income was provided by the government in April and May. On a quarterly basis, when you spread this graph out and look at it over time, it trumps any other period by a large margin and still represents 15 to 16% of consumer income over a quarterly basis. We've had a lot of discussion in the marketplace and in national news about what happens as the CARE Act benefits expire. That $600 a week in unemployment benefits, the stimulus checks from Congress. As we work forward, a new package is going to be built. All indications suggest that it's going to be a smaller windfall payment than the last package of bills. But the challenge going forward is what happens as we work through this, because we still don't know what the new normal is as it's propped up by policy. And how will that affect demand going forward? At the end of the day, we can take comfort in the idea that the U.S. consumer doesn't have to work very long or very hard to enjoy a single pound of U.S. choice beef. Basically, over the last few years, the average is they work about 12 minutes to earn a serving or two of USDA choice beef. So we talk about high retail prices, we talk about struggles with consumer income, but at the end of the day, we still are a very cheap and affordable, nutritious source of food for the U.S. consumer. Where I start getting myself concerned is not absolute benefits or absolute price points. I look at relative price points. And we're in a situation where I could carry this graph back to the 80s. And we were just looking at our U.S. ground beef prices against these two competing protein items, the chicken breast and pork chop. If I took this graph all the way back to the 80s, these uptrends would still exist. But where I get concerned is when we get really stretched out above the trend line. We did it for both pork and chicken as we were back here at the Heisman 15. Today, our biggest disadvantage is against the chicken breast. As we have a consumer who's struggling to get a paycheck, who's living off of some kind of unemployment benefits, or is seeing their workflow dramatically decline because of COVID-19 restrictions, it's really hard to pass up $1 or $2 chicken breast in light of ground beef sitting there at $5 or $6. And so the reality is, through this summer period, we probably are losing some market share to some cheaper competition. As we go forward, getting those price points to be more competitive again with chicken and pork is going to be essential for us to keep this volume moving through the system that's still coming as we work through the end of this year and into next. Another big unknown is China promised through the Phase 1 trade agreements that they would purchase $35 billion worth of agricultural goods this year and $42 billion next year. When the deal was inked, we already saw some challenges in these targets. That was before COVID-19. Because basically, each one of these colored bars represents a different agricultural category. If we rolled up and took the high of each one of those categories back to 2010 and stacked them on top of themselves, we still would fall short of $35 billion in agricultural goods. You probably heard President Trump mention that, hey, he's not real excited about how Phase 1's turned out. He's learned some new things. Things aren't going very well, and this is why. The bar was set awfully high. China failed to meet it, and we can argue that whether COVID-19 would have hit or not, whether they would have ever hit this level. And it's an unknown factor to us today. But we know we're going to fall a little bit short. But we also know that we benefited. Pork exports have been phenomenal to China. We've seen strong poultry exports to China as well. Beef is growing, but it's still a very small share of our total exports, but it's still growing at levels we've not seen before. And there's outstanding sales just waiting to be delivered to China that, if realized, will continue to boost this year in terms of its volume to what we're sending to China. We'll see how it plays out. China's a finicky dance partner, as I mentioned earlier. But having them in our corner, being an aggressive buyer of our commodities, is good for agriculture. We may never feel like this is one of those items we can move into the known category, something that has certainty to it, because that's just not how China plays in the global marketplace. But when they're in your corner, they're buying your goods, you take advantage of it. The last big unknown that I want to lay out in front of you before we go down the home stretch in this presentation is drought. We knew coming into this year, our in-house meteorologist said we were going to be going into a La Nina weather event. Generally, La Nina weather events mean general dryness through the south central plains, a little bit into the west, and then those dry trends tend to move their way Corn Belt into the Midwest. For now, the drought's really stalled out more over the south central plains and into the Rocky Mountain region. It's hitting a significant volume of cow-calf producers, but some of the bigger states outside of Texas are still on the list and enjoying a relatively easier season. Yes, there's some dryness in Kansas, but it's still doing okay. Same with Missouri as we look at it. As we look at Nebraska, there's pockets of dryness that exist there as well. But overall, we've avoided the big red areas in some of those other major cow-calf states. As we look at what the forecast is going forward, August, September, and October, the hotter temperatures are going to start transitioning from the region they've been in more towards the Midwest. As we look at the precip, even if it's a little bit warmer, 2 to 3 degrees warmer on average through that period based on those red areas, the idea is they'll come with just a little bit more rain. 1 to 2.5 more inches on average as you get into some of those darkest of blue shaded areas. And so as we think about this, relative to the corn crop coming into a lot of those areas, we're going to have quite a bit of heat coming. We're going to have quite a bit of precip coming to help out through the end of pollination and setting those ears and filling out that crop. Hopefully those rains start to subside as we get to mid to late September and allow us the opportunity to get that crop off the field in good shape. But everything suggests we are going to have a U.S. corn crop that probably is going to average somewhere between 175 bushels an acre and 180 bushels an acre. It's going to be a very good crop as we look at the fall harvest crop ahead of us. And so now, we kind of know our knowns. We know what uncertainty still exists. How do we maintain discipline? This is one of my favorite graphs. It's a cycle of market emotions. All of us understand exactly what this looks like. As we transition through a market that makes us feel optimistic, to euphoric, to fearful, to depressed, and back to optimism. We went through this as coronavirus hit. I think we're to a point now where we're somewhere between hope and relief. We're on the upside once again. But I mention this to you because at certain points we need to recognize where opportunity exists for us to maximize risk protection or maximize future margin enhancement. When everybody's panicked and it feels like everybody's bailing off the ship, usually that's a point where there's a lot of opportunity. Those of you who bought calves through the last 90 to 120 days recognize that. As we talk about the side where everybody's feeling great, even the barber shop managers talking about getting into the cattle business, that's when you have the most at risk. That's when you try to forward sell this market, be aggressive with futures, and try to lock in some of the price momentum that's hit. Even though we're on the upside of this right now, we still feel like there's a little bit of opportunity still in this marketplace. And so let's talk about what some of that looks like as we continue to navigate this market. One of the things that caused a lot of anxiety, both late last year with a packing plant fire and this year with COVID-19, is the challenge that exists with packing capacity. And when you talk about getting emotional about these markets, there's one surefire way to create some emotional response, and that's talk about packer margins and packing capacity. We're in a situation where we force the packer to work longer hours than normal to kill the number of cattle available. If it was just a 40-hour work week, we'd average 490,000 head of fed slaughter this year. Our projection is closer to a 506 average, which means we're forcing them to work Saturdays, we're forcing them to work longer through the weekdays to kill the cattle that are available to us. The reality is, as we look at this, we're going to get back to a point where we're going to gain leverage back over the packer. And as a result, we're going to gain margin from them. As we look at this, this is simply looking at slaughter capacity versus how big our cow herd was the prior year. On the vertical axis, it's how much of the fed cattle price was taken out of the cutout, wholesale beef value. Back here in 12, 13, 14, and 15, the packer was losing money left and right. They had way more packing capacity than they needed to adequately kill what our cow herd produced. As we went through the recession years and even 16 and 17, we were in relative balance. Some years the cattle producer got a little more margin, some years the packer got a little bit margin. But things were in relative balance. As we flipped the switch and got to 18, 19, and obviously 20, we put ourselves in a place where obviously the cattle producer received a very low share of the wholesale cutout dollar. And so we need to get back to a place where we are today, back towards around 84% of our cow base being represented by fed slaughter. The cow herd's going through a contraction, so this is obviously a moving target. But as we look at it today, the industry could withstand adding somewhere between 2,000 and 5,000 head per weekday of packing capacity. And we think we'll get there. We think we're adding on capacity at some regional plants. We think there's discussions on how to improve throughput at many of the major facilities. And as we continue to reduce the cow herd, that target gets reduced. But what we need to be conscious of is as we look towards the next expansion, how do we maintain discipline? How do we make sure we build the factory to meet the funnel that ends up ultimately hitting us at the processing level? Keep that in mind as we look with not just an eye to 2020 and 2021, but ultimately look to what things look like through this next decade as an industry. As we talk about price points, we think we're going to be in a place where cattle prices are just going to be a chop. We're basically going to see prices for calves, feeder cattle, and fed cattle get back right near to where they were in 2019. There's not a whole lot of difference really as you look at the cattle components in these prices with 2019. Cutout nearly identical, fed cattle price nearly identical, feeders and calves nearly identical, even utility cows within $1. As we work going forward, that's our expectation, that 2020 was an anomaly and 2021 will get back to normal. As we talk about it, different graph than I shared with you earlier, but the same discussion. As we talk about cash-fed cattle prices, we think we can make an industry work where fat cattle are selling in a range between $1 and $1.30. $1.30 may be really tough for us to carve out as we look at the high end of next year, but we think even if we get to kind of the top of the recent practical range around $1.25, that's a price point that most cattle producers in the feedlot business would say they can make work. As we look at it going forward, we've gotten that premium back into the live cattle futures market. We found a practical bottom for calves through this summer. We think a challenge probably still exists from a supply standpoint, that we could actually trade these cattle probably just a little bit weaker as we work into the fall. It's hard to fade that fall seasonal. But we think the bulk of the price lows are in fact, so much so that I'd probably tell you I'd chop the bottom off a little bit early on that red box and say we should find an awful lot of support on a U.S. average basis around $1.50. For those of you that retain ownership in those calves or try to make a decision whether you're going to retain ownership in those calves, I would just tell you that historically speaking, the market's paid you about 90 cents a pound for every pound you can add on a fall weaned calf and take them into February as feeder animals. If you have the feed resources around you, and if you have the opportunity to do that, I'd encourage you to be looking into that again this year, because we should be hungry for calves and have an appetite for feeder cattle as we work into next spring. For those in the feeder market, you feel blessed that you got the recovery that you did through this summer period. For those of you that were selling in this mess in March, April, and May, we got to look ahead to hope for better times. And I think those calf prices that we carved out for you earlier should give you that opportunity. As we look at it, we're probably getting near the top end of the range for feeder cattle. It's hard to fade the highs coming usually that first couple weeks in August. I would imagine we'll challenge 143 to 145 on a 750 weight basis on a U.S. average. We've already seen obviously instances of that trading well beyond that for just the right cattle at the right time and in the right place. We'll chop pretty much sideways through the fall, and then we'll have some downside risk as the fall run gets to us of calves, usually pricing in some supply pressure into that time. For those of you buying dairy calves, this is a really unique time in the marketplace. Typically the seasonal highs are past us, and COVID-19 obviously cut the legs out from under this rally. We expect these to trade very much so in line with where they have the last couple years. with upside then reintroducing itself into the summer. But you all who are in this market recognize that there's some uniqueness. There's some new cattle being introduced into this marketplace, the beef crosses. If we separate those out from the dairy crosses, you'll see that they make up today basically about 7% of the volume. They're trading significantly higher, flirting with between $1.75 and $2 a pound, at the same time that your typical dairy animals are more like 75 cents. And so that 1.6, 1.7 premium for those beef cross animals is reflective of the added value they're adding to the industry. There are roughly about 1 million of those calves out there today. We expect that to grow towards 2 to 3 million as we work to the next 2 or 3 years. Be watching those, looking for opportunities to partner on those genetics. We think that's a direction the industry is likely heading. And then lastly, for our cow-calf guys, you heard me mention it. We're going through contraction now, but we do need to keep a watchful in the future. We need to expand again, but we got to watch and make sure that we don't extend ourselves as deep as we have with buying cows that are expensive relative to the calf market. As we start seeing female prices get back towards this long run average where they're only taking 1.5 calves to pay for that bred female, it's an opportunity to be looking ahead for that opportunity that exists into the future and look for an expansion opportunity again. So lastly, buyers have gained all the leverage in the marketplace due to COVID-19. We got to focus on what we know and be aware of the unknowns and adjust our marketing and risk management appropriately. Beef supplies are going to remain ample all the way through next year. Pork and poultry supplies are stabilizing near their records. We expect pork to give up some of their gains as we work into next year. But regardless, the name of the game is stronger exports and stronger domestic demand. We still have a lot of uncertainty with our domestic consumer relative to their income and expectations for the future. And we know beef's susceptible because it's one of the highest price items in the meat case. As we go forward, depending on your operation, everybody's going to have a different approach to marketing and risk management. And everybody's going to have a different outlook in terms of what the profitability is going to look like for their underlying operation. Be flexible. Build a plan, execute the plan, but give yourself some inherent flexibility to work within that plan to capture those added opportunities for profit that will certainly exist as we work through the rest of this year and into next year. And so I know a lot of you have work to do, things you need to get to, and we're right up against the buffer for time. I want to leave you my contact info. If you have anything you want to discuss, reach out to me via email, lance@cattlefacts.com. Be happy to chat with you and talk to you more about some of the things we mentioned in this deck. So, Josh, I apologize for going just a minute or two over there, but hopefully it was worth everyone's time this morning.
Thank you, Lance, for joining us today and sharing your expertise and insights. And thank you to all of our customers and team members for carving out time to be here as well. We hope you all found value in the information we shared today. We encourage all producers to speak with their lender early and often. If you have additional questions or would like to get in touch to discuss ways Farm Credit Mid-America can support you in your operation, we encourage you to reach out to us. It's been a pleasure to host you, and please know that our thoughts and best wishes are with each of you and your families today and throughout the coming weeks. Best wishes to all of you. We hope to speak with you soon.